Welcome back to the channel, everyone. Today I want to talk about the new SEC hire, Barbara Roper, the senior advisor to Gary Gensler, but how she may not be as good as it sounds. So stay tuned and let's make some money. But before I dive into the video, I just want to give a massive shout out to the team over on the private Discord and the Patreon. There they get urgent news, due diligence and updates about AMC, other stocks and cryptocurrencies as well. And they can ask me questions whenever they like, and they're in with a chance of winning $600 on the 28th of August, which is in only a few days. So if you also want to win $600 and ask me unlimited questions, be sure to join the team in the private Discord and the Patreon, linked in the description below. And now I want to dive straight in with the key information. So, this is Barbara Roper, new senior advisor to Gary Gensler. She's going to be looking out for us retail investors. Maybe after the MOAS, we'll all chip in $1 for a new haircut for her. You may have also seen this news article. SEC's Gary Gensler taps Wall Street critic Barbara Roper as the new senior advisor. Investor protection advocate Roper has called for a more aggressive stance towards Wall Street. SEC chairman Gary Gensler named an outspoken investor protection advocate to his inner circle of advisors on Wednesday. The latest sign he's gearing up to take a more adversarial approach towards Wall Street. Mr. Gensler appointed Barbara Roper, longtime Director of Investor Protection at the Consumer Federation of America, to serve as a senior advisor focused on policy issues, broker-dealer oversight, investment advisor oversight, and examinations. Barb is a champion for investors and will provide invaluable counsel on behalf of the American public, Mr. Gensler said in a statement. He said he's worked with Miss Roper on landmark Wall Street reform projects dating back to the 2002 Sarbanes-Oxley overhaul of public company accounting rules, as well as the Dodd-Frank Act passed in 2010 following the global financial crisis. I'm thrilled to collaborate with her again at the SEC. A prolific writer of comment letters seeking to influence SEC policy, she sent more than 100 to the agency dating back to the 1990s. Ms. Roper has frequently sided against banks, brokers, hedge funds and private equity firms on regulatory issues. She was, at times, harshly critical of Mr. Gensler's predecessor, Jay Clayton, a Wall Street deals lawyer whom she characterised as too close to the financial industry. After the 2020 election, Miss Roper called for President Biden to nominate a candidate for SEC chair who wouldn't shy away from adopting strong rules over opposition form industry and dissenting votes from the pair of Republicans on the SEC's 5-member panel. Now, interestingly, I actually wouldn't have even found this news article if it wasn't for my new partner, Moomoo. Moomoo are an excellent beginner investment platform. They've got super up-to-date news, they've got free level 2 data, and early access to IPOs. Therefore, if you want to get some free stocks with Moomoo, be sure to sign up using the link down in the description below. But I personally don't think all is good as it might sound. Yes, Miss Roper sounds absolutely brilliant because she takes a stance against the banks and has been highly critical in the past of previous SEC chairs, but I think she's hiding a bit of a secret. Now, you may remember this article that came out quite a while ago. Why the GameStop frenzy may hurt retirees along with hedge funds. Retail investors such as Reddit users have targeted stocks like GameStop that are heavily shorted by Wall Street. Some hedge fund losses extend into the double digits. That could spill over to pension plans. Some invest more than 20% of their assets in hedge funds. Now, this article obviously goes more in depth about the January squeeze on GameStop and other stocks like AMC as well. And Miss Roper had a very funny, a very odd comment that she made in this article. Your eat the rich mentality just took a bite out of the pension funds of working Americans. Barbara Roper, Director of Investor Protection at the Consumer Federation of America, said of GameStop investors who targeted Wall Street. It's not a victimless game, and it's not a Wall Street billionaire who's going to ultimately pay the price, Roper added. So therefore, Barbara Roper basically disagrees with squeezing the hedge funds and squeezing the shorts in stocks like AMC and GameStop. Barbara Roper clearly doesn't agree with squeezing the rich or eating the rich, and also doesn't think it's billionaires and hedge funds that are going to pay the price. Therefore, it very much seems like Barbara Roper is siding with the hedge funds and doesn't want them to be squeezed and doesn't want the rich to be eaten. Now, I personally don't think this is very good due diligence from Barbara Roper. If you look at the kind of funds that are shorting AMC and GameStop, like Citadel and Melvin Capital, they're all funds that have private money. Those funds, like pension funds that have public money, aren't shorting AMC or GameStop. In fact, they're going long on AMC and GameStop, and therefore a squeeze would be in her best interest and in the best interest of retirees. Those private funds that are shorting AMC and GameStop, those private funds that hold private money of billionaires, are shorting AMC and GameStop and are potentially likely to be squeezed or are going to be squeezed, and therefore it is solely the billionaires that will feel the wrath of the squeeze. And in fact, actually the working Americans and the retirees and pension funds actually stand to gain massively from an AMC squeeze, especially as it's us, the working Americans, that are the apes and the retail investors that are currently long on AMC and GameStop. Now, the article does actually go on to say how a lot of pension funds do invest in hedge funds, but I think you have to remember that these pension funds typically invest in hedge funds like BlackRock and Vanguard, who are also long on AMC and GameStop. Here it specifically mentions losses for some hedge funds like Candlestick Capital Management, Citron Capital, D1 Capital Partners, Malpa Lane Capital, Melvin Capital and Point72 extended into the double digits. But what you also have to remember is that pretty much all of these hedge funds manage private money for private billionaires. They don't manage public funds like pension fund money. Or on a stereotypical largely basis. Maybe some of those funds do manage small amounts of public money, but they mostly manage large amounts of private money from private billionaires. This is basically summarised by this Reddit post here, who says not too sure why everyone's getting excited for Barbra Roper, the SEC's new hire. She seemed to be against us retail investors back in the January run-up. If she was willing to place all the blame on us back then, I wonder what she's going to do for us now, or what she's going to do for the hedgies. And somebody commented saying she's there to help Gary change the narrative and blame retail. And they can blame retail all they want, as long as my pockets or our pockets are full. There's also a very interesting Reddit post I've just seen here as well that says, if history is repeating itself, what if we aren't yet repeating the $72 run-up? What if we're actually sitting in the pre-run? As we can see here, on the run-up to $72, most of it happened on the break of $14.50 on this candle here, when we then ran up significantly over the next few days. But if we look a week before this candle, we actually had the break of $10 and the run up to $14.50 before cooling off slightly. What if this run up to $48.50 isn't the start of the run up to $72 or the start of the run up to $200 to $300? This is just the pre-run before a small cool off throughout the rest of the week, before the real run up potentially next week. Regardless of when specifically the squeeze happens, I don't really want to set dates. All I'm seeing from the chart is that we've now broken out of this wedge or this triangle and we are back on the move upwards. It seems we've finished cycle 1, we've finished cycle 2, and we're now finally starting cycle 3. I don't really want to set a specific date for when the run-up will happen. All I know is that we've now started cycle 3 and the run-up will happen over the coming few weeks, I imagine. I also found this hilarious Reddit post that I wanted to share with you. It may be a smidge distasteful, but I absolutely couldn't stop laughing when I read it. Guys, I found out why Charles Gasparino is so angry and bitter. Get this guy's 5'8". It's short man syndrome. He's only tough behind a screen. In real life, we could just pick him up and cuddle him. Look at his little legs go. Now again, I guess it is a bit distasteful. There's absolutely nothing wrong with being 5'8". I'm only 5'10", and I never made it past that 6-foot barrier either. But combining that post with that photo absolutely had me rolling. And finally for today, I wanted to touch on the reverse repos. Again, we've now had 11 days consecutively of over 1.1 or over $1 trillion. Now at $1.147 trillion, a new all-time high in the reverse repo market. And again, looking at that daily treasury, a huge steaming outflow of $33 billion, now bringing the closing balance to $284 billion. Again, there's probably only around 10 to 15 days to go before the US Treasury is completely out of money. Guys, be sure to let me know down in the comments below what you think about the SEC's new hire, Barbra Roper. Do you think she's going to protect retail investors, or do you think she's siding with the hedge funds? And as always, guys, if you enjoyed this video, be sure to check out some of my others. Alternatively, subscribe to the channel and ding that notification bell, because that way you'll be alerted when I upload a new video. Cheers.